everyone, today we will talk about what you are looking for, what you are searching for if you are raising capital. So if you are looking to raise capital, so actually you need to understand what the valuation of your project, of your startup, of your company, to understand how you can start to have any conversations with investors. So today, that's exactly what we will talk about. That's exactly what it's all about. How you can calculate the valuation so you can actually get into the navigation sites with the investors and ask what you're gonna ask and have something that you can back up your conversation with. What you will gain from this video, what I will promise you that you will gain from this video, that you will have all the knowledge that you need to have in order to do the evaluation, in order to calculate what the valuation will be for your projects. So in the end of this video, you will get also the tools that you need to have if you're looking to actually calculate the valuation of your startup. You will also get the formula on how you can calculate the valuation of your own startup if you have revenue, and even if you don't have revenue, you will gain completely new insights on how you can do that by your own self. So now let's start with that. Why it matters? Why it matters to actually know what the valuation of your startup. If you don't know what the valuation of your startup, so you can't raise capital. And I'm assuming that you are here to start raising capital, or you're gonna raise capital later on. So if you're gonna raise capital, you need to understand what the valuation of your project. And not only for that, you need also to understand what the valuation of your projects, so you can actually do the calculation later on the exit strategy if you're looking to do that, or even to have that in your strategies. So absolutely it matters. Absolutely it's a game changer once you understand the valuation of your startup, to actually raise up capital, to have conversation with investors, and to back up everything that you are pitching the investors with. So today we'll talk about it. So let's get into it directly. So to raise capital, we have startups that they have already started to generate revenue, and we have a startup that has no revenue yet, correct? That's what everyone know about it. So that's exactly what we have once we start to do the evaluation sites. Market multiply methods, that's what we would like to call it. So what that means, the revenue multiply method involves multiplying the startup's current value by an industry specific multiplier. This multiplier varies widely depending on the sector growth, potential, profitability, and risk. All right, so what that's mean? In this sector, they are taking a look on what these startups they have already done for the last year, all right, what they had for revenue for the last year, and they taking also look on which industries they are into it right now, what it could be the revenue multipliers for the potential growth that this startup has in these industries that they are into it, all right? And they also calculating that over from what they had also for revenue for the last year, all right? So that's exactly what that means. So this valuation formula, it goes only to the startup that they have already revenue. They have already started to generate revenue, and they had revenue for the last 12 months, all right? So let's take a look on how it goes. Now we have example right here. Let's say that we have a SaaS software as a service company that generated 5 million in revenue for the last year. Based on current market trends for the SaaS companies, revenue multipliers can range from 5x to 10x, all right, for faster growing companies in the hot market, correct? So now let's do the calculation over from what we have right here for numbers. So let's assume that the average multiplier will be 7x, all right? Let's assume that it will be that. So we have the annual revenue, it would be 5 million. That's what they have done for the last 12 months, correct? And we have the revenue multiply, it would be 7x. So that's what we have assumed it to be, correct? Now let's take a look on what the valuation would be for this startup. So valuation formula, it goes like that: the owner revenue multiply by the revenue multiply. All right, that's exactly how things going on. So what that mean, the owner revenue, it was 5 million. That's exactly what they have done for the last 12 months, correct? Multiply the 7x that we had as the average multiply is 7x. That's what we have assumed to, correct? And takes over from the growth of the market, growth of the industry, the potential growth of this startup, all right? and how fast they have already started to generate revenue. All right, so keep it in the mind. And what the other competitors, that they are exactly as they are, what they are generating right now after they have been in the market for 3 to 5 years. All right, so keep it in the mind. So that's exactly how things going on. So the valuation, it would be 5 million multiplied 7x, so it would be 35 million. So the valuation of this startup, that it has started before like 1 year and they had only 5 million as a revenue, so it would be, the valuation for them is 35 million. Got it? That's exactly how you calculate the valuation of your startup. If you have already generated revenue, so you have to take up the revenue that you have generated for the last 12 months, and you have to take a look on the markets and the industry, your competitors, what there is potentially growth right here, what they have done for growth for the last 3 to 5 years, how many x they have already multiplied their revenue, and from there, so you can start to do the calculation on it. You can multiply the revenue of the last year, multiply by the revenue multiplier, and the number that will get it is the valuation of your own startup at the current time. So that's exactly how things going on for the startup that they have already revenue. All right. So we have example that we took it up. We have a Salesforce. Salesforce is well-known company in the software industry. Salesforce 2024, it made 31 billion in revenue. All right. So now when people value a company like Salesforce, they often use something called for revenue multiply. All right, that's exactly what we are talking about right here. This means they multiply the company's revenue by a certain number, the multiplier. That's exactly what we have already done right here to estimate how much the company is worth. So for Salesforce, the multiplier is between 6 to 8x. This means that for every dollar Salesforce earns, its values could be 6 to 8 times higher. Got it? I hope so. So for example, if Salesforce made 1 billion in revenue with 7x multiply, the company would be worth 7 billion. All right, we just took the revenue that we have assumed, which is 1 billion, multiplied by the 7x. And the number that we're getting is the current valuation for the Salesforce. All right, so that's what we do. But the current revenue for Salesforce is 31 billion. All right, so it is not the same number. I'm just giving you example right here. Hope you got it. I hope you got the whole point right here. If you don't, so keep watching it. And in the end of this video, I will also leave this Google documents in the description, so you can also download that, and you can also take a look on all the formulas and do the calculation for your own startup, so you can get the valuation formula. What's it's good right here, even so Salesforce is a huge company, early stage startups in the same software industry could be valued using these multiplying methods. So but their multiplying might be higher if they are growing quickly, or lower if they are less established. So what that means, so even if it's, so Salesforce is a huge company, but even if you are a startup right now in your early stage, all right, and you are not generating as much as they are generating today, you would also be valued using the same multiplying methods. You got it? And you will get exactly the same multiply that we have it right here. You got it? Which is it would be like between 6 to 8x it was for Salesforce. So you can also get the same number, and it could be higher for you. All right, it could also be higher for you. Even if you have been in the market for like 12 months, it could be higher for you. Everything, it depends on one thing: how quickly you can generate revenue. Okay, how quickly you can generate revenue. If you are starting your company right now today, how quickly you can generate revenue? How quickly you can generate revenue from today? All right, you got it. So that's what's funny right here. So even if you are early stage startup, you can still to have the same message right here, and to see how much your company valuation is. You can value your company for way more than what the Salesforce is valued. If you are fast growing company, if you are generating revenue fast, quickly, You got it? I hope you got it. This is the first one. The second one, so now we will talk about the pre-revenue startup. All right, so we have two. All right, we have the first one, the market multiplying assets, and we have the second one, which is the pre-revenue startup. So let's take a look on that. Pre-revenue startup, what that means, they don't have any data, they don't have any revenue, they don't have anything yet, which is quite hard to value up the startup, correct? But the startup is valuing up by only 3 or 5 fractions that they are most important right here. So let's take a look. What the investors they take a look on once they want to value up a startup right here, they take a look on the market potential, teams that are behind the project, and what they have for concepts, the product's development stage, and what the future projections could be. You got it? That's exactly what they are valuing up to. And I'm telling you one thing right here that you have also to take it in the mind. Investors, they're valuing up your startup or your company by how protective you are, how your energy is, and how positive you are, and how can you communicate, how you can you speak clearly, and how you can present your startup as your own baby. You got it? So that's exactly what makes sense for any investor to invest into you. They're investing into people more than they are investing into any startups. So make sure to have that in the mind. All right, how this method it works right here, they're valuing up the pre-revenue startup by the risk return methods, or what it calls for method, it calls for venture capital method. All right, so what that means, the VC method, so I will tell you right away. So right here the method it works like that. So they're predicting the future value, all right, when it gets bought or it goes public, okay, and they are discounting the value to today's value, which it call it for the concerning risks and time. All right, I will tell you one time again. So the formula right here to do the valuation for any startup that has no revenue, it goes like that. They take a look on what the future for this startup could be, all right, for 5 years. So what does the future would be in the 5 years for this startup, if it will go public or not, or once it will get bought. All right, and they starting to do the discounting the value of this startup by considering the risks and the time. Okay, so that's exactly how this formula it works. I hope it was clear. And now let's get into it. Let's take a look on that. Exactly as I told you. So estimate the exit value project a company may be worth in the future, typically in 5-10 years. 5 years, that's what the most usual. This could be based on the potential revenue, market size, or the valuation of similar companies. So all right, estimate that the startup's share of the exit value, estimate what the percentage of the exit value the startup will capture. Determine target return. Investors typically expect high returns such as 10x their investments because it's early stage companies. That's exactly what every investor they are looking to get for return once they are investing into early stage companies. As most of the investors, if you have unique concept and if you have right mindset, the right plan behind it, and they are interested, they are quite interested about your project, so they would like to have more, they would like to own more equity of your company. So if you are in the early stage, so you need to have funding to get it on. So they would like actually to be more harsh in the navigation side, and they would actually start to give you high numbers of to own from the company if they love it. And once you see it from their side, so you need to stay at your numbers and don't settle for less than what you have already planned to get for. And if they are interested enough and they see value, so they will go with your deal. So keep that in the mind. So let's take a look on how the formula it works right here. Okay, so let's get into it. So here we go. So we have example here. All right, so let's assume that we have a healthy startup that is still at stage with no revenue but has a promising product and strong team. All right, let's say that, assume that. All right, so estimate exit value after 5 years. That the exit value it would be 5 years. What we have seen based on the projected market demands So it would be in 5 years, it would be 100 million. All right. So 100 million, it would be or in 5 years. That's the exit. You got it? So now if you don't have any revenue, you need to actually pay attention right here, because that's exactly what you need to have for calculation. All right. So investors expected return, it would be 10x. Okay. So that's what they are getting for return. And what the investors, how much the investors they will own of the company, they will own 20%. That's the ownership percentage. All right. So that's the owner of this tech startup will give away from the equity of this startup. They will give away only 20% to the investors. Investors they will have only right for 20%. Correct. The exit will be in 5 years. That's what we have already talked about up there. And future value estimate, the company is expected to be worth 100 million in future after 5 years. That's what we said. And 20% of the company will go to the investor. Now let's take a look here. Now, as I told you before, they will decrease the value of the company. All right, concerning the risks, the time. All right, and here we go. That's it calls the discount rate. All right, the discount rate, it's sitting at 10% per year. All right, which reflects the risk of over 5 years. You got it? That's the discount rate. So that's what we will also use in our valuation formula. All right. So the formula to find the current value, we divide the future value by the factor that represents the risk over time. So the formula looks like the current valuation. It would be the future value, which is a 100 million, the ownership, which is 20%, and number one, that's number one, and now plus the discount rate, which is 10%, and the years count, which is 5 years. You got it? I hope you got it. So that's the current valuation, but you got it? Yes. How the valuation will be? 1 plus discount rate, years future, value, ownership of now. Let's plug in the numbers so you will understand. You see that it's complex. It's not, I'm telling you, it's not complex at all. All right. You just need to do the reps on it. You need to do it multiple times until you will get it. All right. So the current valuation, how we can do that? As I said right here, so that's how we can do it. All right. This is the current valuation. It's the first one that you need to do it. And then you need to do also that. So you will also get the clear number in the end. All right. So you need to apply this too. All right. You can't only do this. All right. You need also to apply this. So current valuation, as we said, 100 million multiply 20%. That's the investor's ownership. And we have one right here. We have it right here. Discount rate, which it was 10%. 5, which is the years count. Correct. And the valuation right here, how we will do it. 1, we have it here, discount rate 10%. Here the years, it would be 5 years, and the future value, it would be 100 million multiplied by 20%, which is the investor's ownership. Correct? So first calculate the future value for the investors, which is, it would be 20%. That's the ownership of the investors of the 100 million. All right, that's the future value. Okay, so let's calculate that. So 100 million multiplied by 0,2, which is that's the 20%. If you know math, I'm also not super good in math, but you need to do math here. All right, 0,2, and it would be 20 million right here. Correct, 20 million, and here you have the 100 million multiply 0,2. Yeah, it would be 20 million. So that's the same formula. All right. So that's exactly how it would be. So now we have 20 million. That's how it would be right here. All right. So that's how it would be the investor's ownership. Now let's calculate. Let's get it into it. Now calculate the discount factor. Correct. So discount factor, it was in the end after we have already done the calculation right here. So we will get this number in the end after we have done the calculation between the total number that we're getting right here and the number that we got for the investors, correct? And now we're getting this number that it was right here. So that's the current valuation for this early stage startup. So the current valuation is 124,000. This is the current valuation of this startup. I hope you got it. I know it was a little bit complex in some way, and it takes some time actually to have it in the mind, but you need to do the reps. You need to take a look on it multiple times. And as I told you, I will leave this Google document in the description so you can take a look on this formula. And keep it in mind, this formula that you need to do, this formula that you need actually to have the numbers of your startup in order to do that. And you can take a look on all the examples after the call. So here we have example right here. Airbnb, you know what Airbnb is. Everyone know about it right now, but before in the time, no one knew it about it, and everyone was actually skeptical about it. And yeah, Airbnb it had only revenue. So Airbnb, it was first starting up. They didn't have much revenue or traction. Starting at the seed stage, it was valued at around $2.5 million, but with potential to reach billions in the future. As investors, they have already seen that the growth in the market and the opportunity in the short term. So by that time, Airbnb raised its series of funding in 2010. It had grown to 10 million in revenue and it was valued at around 1 billion. And it was only at a series of funding, which is absolutely early stage. So you got it. That's example of how things going on. And if you have the potential, if you have the potential in the right time, in the right industry, in the right markets, if you have the needed concept that everyone asking about and the investors, they see that, they have already seen that you understand what you're talking about, they will absolutely invest into you and you will have also killer valuation for early stage startup. So that's exactly how things going on. So for startup with revenue multiply method, a fast straightforward approach using industry multiply. So it would be about between 5 to 10x. That's what it would be for the startups in the SaaS, in the e-commerce. So that's how they are doing the multiply side. So if you have already startup in the SaaS, in the e-commerce, so you need to multiply your 12 months, your last 12 months revenue by 5 to 10x. And then from there, you will get the current valuation of your own startup. All right. So for a startup that has no revenue, if you are one of that, so you need to do the venture capital methods, as I have already showed you. Observe the potential future returns. That's what you have to take it in the mind. Projected exit values, expected risk, and that's what it called for discount rates. Projected exit value, that's what it called for the future value, and potential future returns, that's what it will be calculated with the projected exit value, correct? And you know the other numbers that it would be here in the formula, so you can keep it in the mind, the one right here, the one right here, and the whole formula that you need to have in the mind because you will get it, correct? So that's exactly how things going on. So valuation right here, if you don't have any revenue, valuation is based on the risks of your startup, risk factors such as competition, team's background, and market risk. If you are wondering what you can use for tools to actually take a look on the valuation of your own startup and to actually help you with this formula to understand where you are at of your journey of raising capital or where you are at in your entrepreneurship journey. So you can visit these tools right here, and you can have this Google document directly from the description, as I told you before. So you have a book right here is absolutely killer for analytics on private companies. CB Insights will give you the startup valuation, founding rounds, trends, crunch path. It's also a great source to researching the valuation data on the most of the startups right there. WeDime offers online valuation tools specifically designed for startups. Angelinvestors, great for connecting with investors and getting a sense of industry trends and valuation. So you can also take a look right there if you have already started to interact with other investors, and you can also ask them about, all right, what I can get for valuation for my own startup, and you can just provide all the concept to them and see how things going on. So that was everything for today. I will make sure to record one video as this one every day on raising capital, on making sure that you will have it easy, simple, and fast to raise up the capital for your own startup, and on all the methods that you need to have it in order to make sure that you will go public, or you will do the exit, or to make sure that you will do whatever you want to get. So that was everything for today. I hope it was helpful. And as I told you, if you want to download this Google document, you will find it in the description. That's it. Have a nice day.